All right, let's dive in. This time we're tackling value investing. Looks like you've got us really digging into Benjamin Graham's The Intelligent Investor.
Yeah, it's a classic for a reason.
We've also got some commentary to go with it and even a YouTube video breaking down the main points.
Should give us a good, well-rounded look at things.
Definitely. So, what's the mission for this deep dive? What are we hoping to uncover?
Well, I think the goal is to really get to the heart of Graham's philosophy, understand what makes it so enduring, why it's still relevant today.
Right, because it's been around for a while. This isn't some like hot new investing trend.
Exactly. This is about timeless principles.
Yeah.
And Graham doesn't waste any time getting to the core of it. He starts right off with a fundamental distinction: investing versus speculating.
Okay, so like what sets them apart? Is it just semantics?
No, not at all. It's a whole different mindset. For Graham, true investing, it rests on three pillars. First, you got to do thorough analysis. You got to understand the business you're buying into.
Makes sense. So not just looking at like stock charts and trends.
Right, you got to go deeper. Then second, there's safety of principle. Protecting your initial investment is key.
Don't lose money, right? The first rule of investing.
Got it. And finally, aiming for a suitable return, not necessarily a spectacular one.
Interesting. So not chasing those like overnight riches.
Exactly. It's about building wealth steadily over the long haul. Now, speculation, on the other hand, that's more driven by emotion, trying to ride market trends, and often you see disregard for the actual value of a company.
So more like gambling.
Yeah, you could say that. And Graham, he brings up this great example, Sir Isaac Newton, the calculus guy.
Yeah, pretty smart fella.
Well, even he got caught up in the South Sea bubble and lost a fortune.
Wow. So even geniuses can get swept up in market hype.
It happens to the best of us.
Mm-hmm.
And that's precisely why Graham stresses developing what he calls the intelligent investor mindset.
Okay, so what does that mean? Do you have to be a math whiz to be a successful investor?
Not at all. It's not about being a genius. It's about cultivating patience, discipline, and emotional control. Think of it as building a system to protect yourself from, well, yourself.
Because we all have those impulsive moments, right?
Oh, yeah. Especially when it comes to money. We see a stock soaring and we think, I got to get in on that.
FOMO, right? Fear of missing out.
Exactly. And that's when you can make costly mistakes. So Graham, he offers this concrete tactic to stay disciplined. It's called dollar cost averaging.
Dollar cost averaging, I've heard of that. How does that work again?
Well, instead of trying to time the market perfectly, which is almost impossible, you invest a set amount at regular intervals, say every month.
So you're not putting all your eggs in one basket at like the supposed perfect time.
Right. It takes the pressure off trying to predict the peaks and valleys.
That makes a lot of sense. And it probably helps avoid those like knee-jerk reactions when the market gets jumpy.
Exactly. Now, another big factor that Graham talks about is inflation. Like a silent thief, slowly eating away at your purchasing power over time.
Yeah, inflation is definitely something on everyone's mind these days.
It's crucial to consider it. A lot of people think stocks are always the answer to inflation. But Graham, he digs a little deeper.
So are stocks not a good hedge against inflation?
They can be, but only if you're buying them at a reasonable price. You don't want to overpay just because you're worried about inflation.
Makes sense. So what does Graham suggest for those of us worried about inflation, eating away at our returns?
Well, he reminds us that bonds can also play a role. Certain types of bonds, like REITs, those are real estate investment trusts, and TIPS, which are Treasury inflation-protected securities.
Okay, those sound kind of complicated.
They can be, but the basic idea is that they're designed to offer some protection against inflation. REITs, for example, often see their value go up as inflation rises.
So it's not just about stocks versus bonds. It's about understanding the nuances within each asset class.
Absolutely. Diversification is key. Now, Graham takes us on this really fascinating journey through a century of stock market history. You see the booms, the busts, everything in between.
The market's definitely had its ups and downs. What stands out to you from all that data?
Well, I think it's fascinating how much the market has changed over time, yet certain things remain constant. Graham highlights the danger of assuming that past returns will just continue forever. Like extrapolating from what's happened before.
People tend to do that, right? Especially when the market's been on a tear for a while.
They get caught up in the excitement and they think it'll just keep going up. But Graham was skeptical of those overly optimistic predictions. Like, remember the Dow 36,000 hype back in the late 90s?
Oh, yeah, and then the dot-com bubble burst.
Exactly. He uses these examples to show that market cycles are inevitable. You can't escape them. So instead of trying to time the market, which is notoriously difficult, he says investors should focus on finding undervalued companies, what he calls bargain issues, and then holding on to them for the long term.
So it's not about riding the roller coaster. It's more like plotting a course and sticking to it.
Precisely. Now, Graham, he recognizes that not all investors are created equal. He outlines two main profiles, the defensive investor and the enterprising investor.
Okay, so let's break those down. Starting with the defensive investor, what's their main goal?
The defensive investor, they primarily want a solid strategy. They're not trying to become Wall Street gurus or beat the market by a huge margin. They just want to protect and grow their wealth steadily without a lot of fuss.
Sounds like a lot of people could relate to that. So what's Graham's advice for them?
He recommends this simple yet powerful approach, a 50-50 allocation between stocks and bonds, with regular rebalancing. This helps to make sure they're not overly exposed to either asset class, no matter what the market's doing.
Okay, that makes sense. And rebalancing, that means periodically adjusting your portfolio to get back to that 50-50 split.
Exactly. Because over time, as stocks or bonds perform differently, your portfolio can drift away from that target allocation. So you rebalance to keep things in line.
So even for the defensive investor, it's not just a set it and forget it kind of deal.
Definitely not. You still need to pay attention, make adjustments, stay informed. Now, for the enterprising investor, things get a bit more, well, enterprising.
Right. These are the folks who are willing to put in more time, more effort, maybe do some deeper research.
Exactly. They're aiming for outperformance, but doing it intelligently.
Okay, so what kind of strategies does Graham suggest for these investors?
Well, he dives into things like special situations. These could involve mergers, acquisitions, or other unique events that create, opportunities for savvy investors.
So situations where you really need to understand what's happening beneath the surface.
You got it. He also talks about arbitrage, which is basically exploiting price differences between different markets. But even for the more aggressive investor, Graham emphasizes this. It's not just about what you buy, it's also about what you avoid.
Okay, so what are some of the things he warns against?
He uses these really compelling cautionary tales. Like there's this great example of the collapse of WorldCom. Remember that?
Oh, yeah, that was a big one.
Exactly. It illustrates the potential pitfalls of those high-yield bonds. The ones that seem tempting because of their high returns.
Because high returns usually come with higher risk, right?
Exactly.
Right.
And Graham, he just drives that point home. He wants investors to be aware of the potential downsides, not just chase those flashy returns.
So it's about finding the right balance between risk and a reward.
Absolutely. You have to understand both sides of the equation.
Yeah.
And that brings us to one of Graham's, I think, most important concepts, thorough analysis. And it's especially crucial when it comes to stock selection.
Okay, so let's dig into that. When it comes to picking stocks, what are some of Graham's key criteria?
He advocates for a quantitative approach, looking at measurable factors like a company's earnings, their assets, how much debt they have, whether they pay dividends, things like that.
So concrete numbers, not just gut feelings.
Right. You got to have the data to back up your decisions.
Yeah.
And he's famous for this idea of margin of safety.
Margin of safety, what does that mean exactly?
It means buying stocks at a price that's significantly lower than their intrinsic value. So you're basically getting a bargain, which provides a cushion against potential losses.
It's like that saying, buy a dollar for 50 cents.
Exactly. But figuring out a company's intrinsic value, that can be tricky. It's not always straightforward.
Right, because it's not just about the current price, it's about what the company is actually worth or what it could be worth in the future.
Exactly. It requires careful analysis, understanding the company's industry, looking at their financials, being realistic about their future prospects.
So it's about combining those concrete numbers with a good dose of judgment and, like you said, thorough analysis.
You got it. And one of Graham's most insightful points, I think, is this. He says investors should be business analysts, not just security analysts.
What's the difference?
Well, a security analyst, they might just focus on stock charts, trends, market movements. But a business analyst, they dig deeper. They look at the business itself, the management, the competitive advantages, the long-term potential.
So it's like understanding the story behind the numbers, not just the numbers themselves.
Exactly. And I think that's such a valuable lesson for any investor.
Okay, now where do things like mutual funds and index funds fit into Graham's philosophy? They're so popular these days.
Yeah, they're everywhere. Graham actually acknowledged that mutual funds can be useful, especially for investors who don't have the time or expertise to pick individual stocks.
Mm,
But he was also cautious about them.
why is that?
Well, he warned that they're not a foolproof solution. Even professional fund managers, they don't always beat the market.
Right, and then you have to factor in fees, which can eat into your returns.
Exactly. That's why he was particularly drawn to index funds.
Because they're generally low cost and passively managed.
Right. They track a specific market index, so you're not relying on a manager to try and pick winners and losers.
So more of a, like, set it and forget it approach.
Kind of. But still, you need to do your research and choose your index funds wisely,
Right, and not get lured in by those promises of, like, guaranteed returns.
which never exists. No one can guarantee returns in the market.
Okay, so what about seeking professional advice? When does that make sense?
Graham acknowledged that some investors might benefit from professional guidance, especially if they have complex financial situations or just, feel overwhelmed by the whole process.
It can be intimidating, especially for beginners. There's so much information out there.
Absolutely. And finding the right advisor, that's key.
So what should people look for?
Well, first, make sure the advisor is a fiduciary. That means they're legally obligated to put your needs first, not their own.
Okay, that's essential. You want someone who's truly on your side.
Exactly.
Hmm.
It's also a good idea to get recommendations from people you trust, family, friends, colleagues who've had good experiences with advisors.
Right, word of mouth is powerful.
It is. And don't be afraid to ask a lot of questions. Make sure you understand how the advisor gets paid, what their investment philosophy is, how they'll communicate with you.
It's a big decision. You're essentially entrusting someone with your financial future.
You are. So take your time, do your research, and make sure you feel comfortable with the person you choose.
Now, Graham, he uses a lot of case studies throughout the book. Why are those so important?
Well, they bring his principles to life. These aren't just abstract ideas. They're real-world examples of how things play out in the market. He looks at companies like Penn Central Railroad, Linktemco Vought, NVF, AAA Enterprises. Some of these companies did incredibly well, others, well, not so much.
And he breaks down the reasons why.
Exactly. He shows how those fundamental principles of value investing, or sometimes the lack thereof, played a crucial role in their success or failure.
So it's like learning from history.
Exactly. He's saying, look, this is what happened. Let's see what lessons we can draw from it.
It's like a reminder that the market can be unpredictable, but there are certain principles that can help you navigate it.
Exactly. And that's really what Graham's all about.
All right, well, this has been a fascinating start. We've just scratched the surface of Graham's The Intelligent Investor. There's still so much more to unpack.
Definitely. We've got a lot more to cover.
We'll dive deeper into those specific strategies for both the defensive and the enterprising investor. Plus, we'll explore some of those psychological traps that can trip us up and how to avoid them.
Looking forward to it.
Me too. But for now, we'll leave it there. Join us next time as we continue our deep dive into the world of value investing. It's really striking how much of Graham's approach comes down to psychology, Not just the numbers.
Oh, absolutely. He understood that. You can have all the financial knowledge in the world, but if you can't manage your emotions, you're going to make some, well, let's just say, not so smart decisions.
Right. Like we've all felt that pull to get swept up in the excitement of the market, especially when it seems like everyone's making money so easily.
Yeah, and that's when you've got to be extra cautious. Remember that Mr. Market analogy Graham uses?
Oh, right. The one who shows up at your door every day wanting to buy or sell your stocks.
Exactly. He's not there to be your guide. He's there to serve you. And his wild mood swings, well, those can be a huge opportunity if you can keep a level head.
So it's like you need to have a poker face even when you just want to go all in on something.
That's a great way to put it. It's about discipline, not getting swayed by the crowd. Now, for the defensive investor, that 50-50 stock bond allocation Graham talks about, that seems really appealing. You're not putting all your eggs in one basket.
And you mentioned rebalancing earlier, too, keeping that balance in check. It seems like a good way to stay disciplined, not getting too attached to any one investment.
Exactly. It forces you to take a step back, look at the bigger picture. And yeah, it's a long-term game. But even with that simple approach, Graham doesn't just let the defensive investor off the hook when it comes to stock picking.
Right, because they still have to choose which stocks to buy. So how does he approach that? It can feel really overwhelming, even for someone who, understands the basics.
Well, he lays out these 7 criteria for selecting common stocks. Some of them might seem a little old school, maybe. in today's market,
Hmm.
but they boil down to some pretty timeless principles.
He's looking for companies with a solid track record, right? Consistent earnings, manageable debt, like the real fundamentals.
Exactly. Companies that are built to last. Now, on the other side, for the enterprising investor, the one who's willing to put in the extra work, Graham gets into some more, well, let's say, intricate strategies.
We touched on special situations earlier and arbitrage. Those definitely seem like you need some specialized knowledge.
You do. And he even talks about these situations he calls net current asset plays, where a company's current assets are actually worth more than its market cap.
So the company's theoretically worth more if you, like, liquidated it.
Essentially, yeah. But finding those opportunities, it requires some serious analysis. You have to be comfortable with balance sheets, financial statements.
It's definitely not for the faint of heart. But even for the, let's say, more adventurous investor, Graham stresses this. It's not just about what to buy, it's about what to avoid.
That's so key, knowing when to walk away.
You were talking earlier about high-yield bonds, the ones that can be tempting because they offer those, big returns.
Right. And Graham uses examples like WorldCom to show that those high returns often come with big risks. It's that classic saying, if it seems too good to be true.
It probably is.
Exactly. He wants investors to be aware of that. Now, here's something I found surprising. Graham was actually pretty skeptical of Wall Street analysts.
Really? He don't trust the experts?
Not blindly, no. He even suggested that randomly chosen portfolios could often outperform those managed by the pros.
So are we just supposed to throw darts at a list of stocks?
Not quite. But he's saying you shouldn't blindly follow the herd. Don't assume that the so-called experts always know best. You have to think for yourself, do your own research, develop your own judgment.
It's about empowering yourself, not relying on someone else to make your decisions for you.
Exactly. Now, another area where Graham goes against the grain is his view on dividends.
Oh, what does he say about those?
He actually argued that companies should be more generous with their dividend payouts.
That's interesting. It seems like a lot of companies these days are more focused on stock buybacks or, pouring those profits back into growth.
Right. But Graham saw dividends as a real sign of a company's financial health and a reward for long-term shareholders.
Like a way for the company to say, hey, we're doing well and we want you to share in that success.
Exactly. And he also pointed out that buybacks can sometimes be used to, well, manipulate earnings, maybe benefit executives more than shareholders. It's something to be aware of.
Okay, so let's bring it all back to one of Graham's most important ideas, margin of safety. You mentioned it earlier, but it seems like this is really at the heart of his whole approach.
It is. It's all about buying stocks at a significant discount to their intrinsic value, which gives you that cushion, that protection against losses.
Like a built-in safety net for your portfolio.
You got it. But figuring out that margin of safety, it's not just about plugging numbers into a formula. It requires careful analysis. You have to look at the company's financials, understand their competitive landscape, and assess their future prospects.
So it's a combination of art and science, I guess.
You could say that. It's not just about being a number cruncher. You need to have good judgment, too. And maybe even a little bit of, well, healthy skepticism.
Not letting your enthusiasm run away with you. Okay, so those case studies Graham uses throughout the book, they seem like a powerful way to illustrate the consequences of, well, both good and bad decisions.
They are. Remember those companies we mentioned earlier? Penn Central Railroad, Ling Temco Vought, NVF, AAA Enterprises. They show that even seemingly successful companies can be built on, let's just say, less than solid ground.
And those foundations can crumble really fast when the market turns, right?
They can. It's a good reminder that there are no guarantees in the stock market. You have to do your homework and understand the risks you're taking. And those case studies also show that having that margin of safety, it can really help you when things go wrong. It's like that extra layer of protection.
So it's not about being pessimistic, it's about being prepared. Now, another thing I want to touch on is the psychological side of investing. It seems like a lot of Graham's advice comes back to that.
Oh, absolutely. Remember Mr. Market, the one who's always trying to get you to react emotionally?
Right, like he's the embodiment of all those irrational forces in the market.
Exactly. And Graham, he really gets that. He knew that emotions, especially fear and greed, can lead investors astray.
So how do we combat that? How do we become more, well, let's say rational in our approach?
One thing Graham suggests is to have a well-defined investment plan. Write it down, review it regularly, and stick to it. This helps you stay grounded even when the market gets crazy.
So it's like a roadmap for your investments. You know where you're going, even when the terrain gets rough.
I like that. And don't forget about dollar cost averaging.
That's that steady approach to investing, not trying to time the market perfectly.
Right. It takes some of the emotion out of the equation. And remember rebalancing, too, keeping those asset allocations in check.
Right, to make sure you're not taking on too much risk, even when certain assets are doing really well. Now, you mentioned convertible securities earlier. I have to admit, those still seem a little mysterious to me.
Yeah, they're kind of a hybrid, a mix between stocks and bonds.
So, potentially less risky than stocks, but with more upside potential than bonds.
That's the idea. But Graham, he was cautious about them. He said they can be complex and sometimes, well, misleading. Investors need to really understand what they're getting into.
Okay, so do your research before you jump in. Now, let's shift gears a bit and talk about something Graham was really passionate about: shareholder rights and corporate governance.
Yeah, it's an important topic. We've seen, unfortunately, a lot of scandals over the years. Companies behaving badly, executives putting their own interests ahead of shareholders.
It's good to be reminded that those things happen. So how did Graham approach this issue?
He was a big advocate for shareholder activism.
Yeah.
He believed that shareholders have a responsibility to be engaged, not just passive bystanders.
So, like, reading those proxy statements, voting on important issues.
Exactly, holding management accountable. And it reminds me of that idea you mentioned earlier, ESG investing, taking into account environmental, social, and governance factors.
Right. It's about aligning your investments with your values.
Exactly. And I think Graham, even though he was writing decades ago, would really appreciated that. Okay, so as we head towards the end of The Intelligent Investor, what are some of the key themes Graham comes back to?
I'm curious to see how he ties it all together.
Well, he reiterates those core principles: the importance of thorough analysis, margin of safety, emotional discipline, and he emphasizes the need to be a lifelong learner. The markets are always changing, and you have to change with them.
So don't get complacent, always be learning.
Exactly. And he leaves the reader with this really powerful message. Successful investing, it's not just about being smart. It's about having character, having patience, having the humility to learn from your mistakes.
I like that. Investing is a journey of personal growth, too. Okay, well, now that we've really dug into Graham's book, let's look at some of the more, well, modern perspectives. We have that commentary, and there's that YouTube video breaking down the book's main points.
Right. It'll be interesting to see how Graham's ideas are being interpreted and applied in today's market.
It's been a while since he wrote The Intelligent Investor, after all.
It has. But I think you'll see that his principles are still just as relevant today as they were back then.
Okay, so what are some of the things that jumped out at you from those modern perspectives?
Well, one thing that really struck me is the continued focus on investor psychology. Graham touched on it, of course, but those modern commentators really go deep on the behavioral biases and emotional traps that can, well, let's say, mess up even the most well-intentioned investor.
Right. It's like our brains are sometimes wired to work against us, especially when it comes to money.
It's true. They talk about things like confirmation bias, where we tend to seek out information that confirms our existing beliefs, even if it's not accurate.
We just want to be right.
Exactly. And then there's loss aversion, where we feel the pain of loss much more strongly than the pleasure of an equivalent gain. So we might hold on to losing investments for too long or sell winners prematurely.
It's fascinating how our emotions can really get in the way of making sound financial decisions.
It is. And that's why having a solid investment plan, sticking to your strategy, and not letting emotions cloud your judgment, it's absolutely crucial.
Right. Having that discipline is key. And speaking of clear explanations, that YouTube video we included, it does a great job of summarizing Graham's main points.
It does. It's a great resource for anyone who wants a, quick overview of his core concepts. And it really highlights how timeless those concepts are. They're just as relevant today as they were decades ago.
Now, one thing that caught my eye in those modern commentaries was the discussion of index funds. They've become so popular, and that video really breaks down why.
Yeah, index funds are a great option for a lot of investors, especially those who are just starting out. They offer broad market exposure, low costs, and you don't have to try and pick individual stocks, which can be really challenging.
Even for the experts.
Exactly. So index funds can be a really smart choice. Now, before we move on, I wanted to circle back to those case studies. They're so fascinating.
They really bring the concepts to life.
They do. They're not just abstract theory, They show how these principles play out in the real world.
Those companies we talked about, Penn Central Railroad, Lingtemco Vought, NVF, AAA Enterprises, seeing how some succeeded, some failed. It's a powerful lesson.
It is. It's a reminder that nothing is guaranteed in the market. But you can increase your odds of success by following those fundamental principles of value investing.
All right, so we've covered a lot of ground here. We've gone deep into Graham's book. We've looked at some modern interpretations. We've even watched a YouTube video. So what are the biggest takeaways for our listeners? What do we want them to walk away with?
Well, I think one of the most important things is to have a sound investment philosophy. This means understanding your risk tolerance, your goals, and the principles that will guide your decisions.
And to make sure that philosophy is grounded in research and analysis, not just, emotions or following the latest trends.
Exactly. And remember, there's no one-size-fits-all approach. Your philosophy should be tailored to your individual circumstances. Another key takeaway, and we've said this a few times, but it's worth repeating, you need discipline. Investing is a long game, and you got to have the patience to stick with your plan.
Right. And resist the urge to react emotionally to every little market blip.
Exactly. Remember Mr. Market. He's always there trying to tempt you. Now, one last takeaway, and this is a big one. Margin of safety.
That buffer, that cushion against potential losses.
It's one of Graham's most important concepts, and it's essential in today's market, where things can be so volatile. So as you continue your journey into the world of investing, remember, knowledge is power. Keep learning, keep exploring, and don't ever stop questioning.
And don't be afraid to ask for help. There are plenty of resources out there, books, articles, websites, financial advisors. Find what works for you.
That's great advice. And remember, you're the one in control of your financial future. Make sure you're making informed decisions that align with your goals.
All right, so we've talked a lot about the theory of value investing, but now let's get down to brass tacks. How can our listeners actually put these principles into practice?
Well, the first step is to start learning. Read The Intelligent Investor, of course, but also explore other resources. There are tons of great books, articles, websites dedicated to value investing.
And don't be afraid to experiment a little. Maybe start with a paper portfolio, where you're not actually risking any real money, just to get a feel for how things work.
That's a great idea. It's a low-risk way to test out your strategies, see what works for you, and over time, as you gain more experience and confidence, you can start investing with real money. But start small. Don't go all in right away.
Right. Dip your toes in, see how it feels. And remember, there's no one right way to invest. What matters most is finding an approach that you're comfortable with, one that aligns with your goals and your risk tolerance.
Exactly. Investing should be a personalized journey. It's not about following someone else's blueprint. It's about creating a plan that works for you.
Yeah.
And remember, it's okay to make mistakes. Everyone does. The key is to learn from them and keep moving forward.
Now, before we wrap up this deep dive, let's leave our listeners with a final thought, something to ponder as they continue their investing journey. What's one key idea that you hope will stick with them?
Well, I think the biggest thing is this. Investing isn't just about picking stocks or bonds or whatever. It's about building a foundation for your financial future. It's about creating security, freedom, and the ability to live the life you want.
That's a great way to put it. It's not just about the numbers, it's about what those numbers represent.
Exactly. So as you embark on this journey, remember to keep your goals in mind, to stay disciplined, to keep learning, and most importantly, to enjoy the process.
All right, that's a wrap for our deep dive into the world of value investing. We hope you found it insightful, informative, and maybe even a little inspiring. Yeah, that's a great way to think about it. Always be growing, right? So, to wrap up our look at Graham's wisdom, I want to bring up something he poses in the book. He asks, are you a business analyst or a security analyst?
Oh, that's such a great question. It really gets to the heart of things, doesn't it?
It does. So, for someone who might not be familiar with that distinction, how would you explain it?
Well, the security analysts, they can get so caught up in the day-to-day noise of the market, chasing trends, jumping on the latest hot stock tip, but never really understanding what they're buying into.
They're just looking at the surface level.
Exactly. But the business analyst, they're playing a different game. They're digging deep into a company, understanding its management, its competitive advantages, its long-term potential for growth. They're looking years down the line.
They're looking for value that others might miss, and they're willing to wait for that value to be realized.
Precisely. That long-term perspective is key.
And that's really the essence of value investing, isn't it? It's not about quick flips or timing the market perfectly. It's about building wealth steadily over time.
Absolutely. It's about being an owner, not just a trader.
Yeah.
As we wrap up this deep dive, what are some of the key ideas you hope our listeners will take away?
Well, for me, it all comes back to having that solid investment philosophy. It's like a compass that guides your decisions even when the market gets stormy.
Right. It gives you that anchor.
And it's got to be rooted in sound principles, not just emotions or speculation.
Definitely. And it's important to remember that it's not one size fits all either. Your philosophy needs to reflect your own risk tolerance, your goals, your time frame.
Right. It's about finding what works for you. Another big takeaway, and we've touched on this a lot, is discipline. Investing's a marathon, not a sprint, and you need that staying power to stick with your plan.
And remember, Mr. Market, always trying to lure you off course with his wild mood swings.
Exactly. Don't let those emotions dictate your moves. Okay, we can't wrap up without hitting on margin of safety one more time.
Ah, yes, that all-important buffer against losses.
It's essential in today's market, with all its uncertainty and volatility.
Couldn't agree more. So, to our listeners, as you continue your journey into the world of investing, remember this. Knowledge is your greatest asset. Keep learning, keep exploring, and never stop questioning.
That's fantastic advice. Well, that brings us to the end of our deep dive into value investing. We hope this has given you a solid foundation to build upon.
We've covered a lot of ground, but remember, this is just the beginning. There's always more to learn and explore.
Exactly. The journey of investing is a lifelong one. So stay curious, stay informed, and most importantly, stay true to your own investment philosophy. That's it for this deep dive. Thanks for joining us.